A very good evening to all. This is the 12th Shastrat session that we are hosting today, and the topic is of significant importance to us. It is in respect to the NBFC lending practice in light of the new supervisory environment. Why I'm saying new is not because of any new regulations being introduced, but the new supervisory environment is pursuant to the various recent actions that the RBI has been taking on various NBFCs. Recently, the action taken against the four NBFCs. Pursuant to that, followed by that action, the RBI has urged all NBFCs to inform their board about the supervisory measures and to implement necessary internal corrective actions. Now, this has left the management of all these NBFCs feeling anxious and uncertain because what are the specific steps that are required to be taken? Nothing as such has been specified in the press release, which with respect to the actual reason, actual gaps and deficiencies. The supervisor particularly expects NBFCs to reassess their interest rate policies, some of the practices with respect to fair lending, or various other critical issues have been highlighted in the press release. What exactly needs to be done and what kind of introspection or compliance revision are necessary? What type of NBFC is majorly hit by this, or is there any specific type of NBFC or specific type of loan product or any practice that is more at risk? These are pressing questions which is there on everyone's mind. Our today's discussion aims to delve into these issues, acknowledging that while clear answers may be elusive, but it will help in highlighting key concerns and arriving at least some actionables. We have with us Mr. Kothari joining us and who will be answering our questions. We have received some questions from the participants as well. And in case during the discussions, if you feel that there are questions that you would want to ask, you may please post it in the chat box. We'll be happy to take that up. But some of the questions that maybe I have in my mind and based on the interactions with various NBFCs, I'll take the privilege to ask it to you, Vinod sir. Shall I start?
Yes, Anita, please do.
Okay. So, sir, first of all, out of the various critical issues of lending practices that the RBI has raised concerns on, the excessive interest rate seems to be one recurring issue. RBI has mentioned that the weighted average lending rate and the interest spread charged over the cost of funds, these are found to be excessive, exorbitant, and they are not in adherence to the regulations. Now, as such, there is no regulatory provisions laying down the interest rates for NBFCs. So, what do we consider as excessive or exorbitant? And what is the approach that NBFCs should follow to have a check on their interest rate model? What is it that needs to be done by the NBFCs pursuant to this particular uh, concern that the RBI has raised?
Hmm. I would say the question is as good as tough, and therefore, like you mentioned, answer to such a question is difficult. All we can do is to have a discussion. If I was to think of, was there at any point of time any regulation on interest rates, capping the interest rates? We have had a law called Usurious Lending Practices Act for long time, pre-independence era. There has never been a cap as such on interest rates. Money lending laws of states do impose certain caps, certain kinds of caps, but specifically money lending laws, it's now been held by Supreme Court also do not apply to non-banking finance companies. So there is no cap as such. In case of microfinance entities, well, initially there was a cap, then there was a cap on the net interest margin. Even that was done away with, which means there is no cap either on the rate of interest per se or on the spread as well. So interest rates are completely left to the discretion of the lenders, though one would get to hear the regulator making a generic statement, and time and again, it's not something which is based on the press release that we're talking about. Time and again, the RBI has been saying that we don't want NBFCs to misuse the liberty. We don't want NBFCs to use this deregulated environment to their advantage. At the same time, the Motherhood statement that lenders should use fair lending practices has always been available. So in terms of regulators' guidance, all lending rates, there never was one. There is even now no guidance at all. Now, therefore, it's left to your judgment as to what you think is excessive. If I knew what I was doing is excessive, I wouldn't do it. And therefore, I was doing it because I think I can do it. Now, there are two things one needs to understand that in the situation where lenders currently are, um, let me start with a little more phased answer to the question. First question is, do we look at interest rates in isolation, or do we look at interest rates in the backdrop of the facts of the loan? You can buy a cup of tea for a price of rupees 10. I can probably think of the cheapest price would probably be, I don't think less than 10 rupees feasible. At the same time, at the airports in the country, you would probably pay 300 rupees to buy a large cup of water with some tea into it. So if 10 rupees to 300 rupees is the price of a cup of tea, you're talking about a 30x difference between the two. Rates of interest is probably loans are available at a rate of, let's say, 9%. Loans are available at a rate of 30%. Loans are probably sold at a rate of 50%. That's question basically is that there are situations which differentiate the loan by various factors. What could be the factors? The factors could number be, well, in pricing of a loan, what are the critical factors? A, what's the cost of capital of the lender? B, what is the risk premium depending on the riskiness of the loan? What's the loan tenure? What is the loan processing cost? More importantly, these days, what's the loan acquisition cost? Because most of the loans are acquired either through intermediaries these days, or even if they are self-originated, even then there are acquisition costs. For example, I pay my people, I have loan origination costs. So there are costs which are absolute numbers. A loan acquisition cost of, for example, 500 rupees will not change based on a loan size. Loan size could be 5,000. I'll probably pay the same cost. Loan size could be 5 lakh. I'll still pay the same cost. So some of these costs I refer to are absolute. Some of these are relatable to the loan size. For example, credit risk premium is still based on how much loan I have given. So therefore, the pricing of a loan will be a mix of various factors. I mean, if you go back as to how to price a credit, one goes into a complete mathematical approach determining cost of capital, which itself has a inherent function of cost of equity. Cost of equity also would be different for different people. Even though my lending rate is the same, let's say different people are able to borrow at the same rate, cost of equity could be well different. So weighted average cost of capital, which is a mix of A, how much equity, how much debt, what's the cost of debt, what's the cost of equity. Cost of equity is itself dependent on the riskiness of business, which means the shareholders dictate what's the cost of equity. That itself therefore becomes a big component. Then the cost of risk, which is these days easy to measure because most of the lenders compute so-called expected credit losses. Risk premium, however, is not merely for the expected credit losses. Risk premium also goes for the so-called unexpected credit losses. Expected credit loss, you probably debit in P&L account. Unexpected credit loss, you don't debit. But that also is an element of the cost. I need to therefore feature or figure out that as well. Cost of overheads, including the loan acquisition cost, loan servicing cost, etc., etc. That is what forms the eventual price of a loan. Like I mentioned, since several of these costs are absolute numbers, therefore loan size is small or the loan tenure is small, or both loan size and loan tenure is small, that would mean the cost of the loan will anyway go up. For instance, someone is taking a loan of 5,000 rupees for a period of 3 months. With the absolute numbers being what I mentioned, the rate of interest might be as high as 48% and still may give a profit of barely 500 rupees to the lender. Because you're talking about a small tenure as well as small loan size. So absolute numbers, in other words, looking at APRs and ROI is one side of the story. Another very important side, which mostly lenders also don't look at. I rarely think supervisors look at that. That's a very important part, which is net present value of the loan, NPV. Present value the loan spread over the tenure to find how much is it in absolute numbers. It might look like 48%, but it's giving me a profit of only 500 rupees in absolute terms. So I've spent 250 rupees to acquire the loan. I probably will be sitting and servicing the loan. I'm making a meager profit of 500 rupees. though the rate of interest looks like 48%. So one very important parameter is we cannot look at rate of interest as a number. We need to look at the various factors that go into computing the rate of interest. Second point, which is very important in today's scenario, where, let me put it this way, rates of interest could have been objected to by a regulator in two situations. A, the disclosure of rate of interest was not fair. The disclosure was not fair or transparent. And B, the borrowers didn't have a choice. So as far as borrowers not having a choice, I think we completely rule it. I think almost any borrower, no matter what is the credit profile of the borrower, has plenty of options. I think loan apps, I wouldn't call them loan sharks, are waiting to lend to the worst of the borrower possible. I am told by some people that even there are lenders who lend to defaulted borrowers who have default history, those who have turned NPS, are also able to get a loan. So I think no matter what, if there is an individual who is a KYC record, no matter how bad his credit history is, he probably would be able to get a loan, not just from one, but from several lenders competing against each other. So if in the competitive scenario, disclosure is properly made about fair and proper disclosure about rates of interest, I don't know if regulators actually have a role to play. I mean, I would have probably argued that it's then a free market. The lender tells you what rate of interest it's charging. The borrower knows what it's paying. The borrower has a choice, which means it's not, a non-competitive market, imperfect competition in the market. Therefore, I can be fleeced because I don't have an option. There's no fleecing game at all because there are plenty of options. In that situation, do regulators actually have a lot to worry about rates of interest? That's a question. However, it's always been, I think, that should always remain a policymaker's perspective that, well, assuming that somebody borrows when I need to borrow, you are taking advantage of a need, and therefore you shouldn't be made to pay exorbitant rates of interest because the borrower is borrowing out of some kind of a need, some kind of necessity. This point about a needy borrower into some financial difficulty, who is made to borrow at high rates and therefore pulls or puts himself into a debt trap. This has been argued for decades and decades and becomes all the more important when you talk about bottom of pyramid borrowers, particularly in case of microfinance. So whenever you find a central banker, including quite often the governor himself, makes a public statement, you find he'll always come to microfinance because that's where the concern about rates of interest becomes all the more critical. You're talking about a bottom of pyramid borrower, somebody who's a needy person trying to use the loan to make, to balance out certain financial imbalances. Therefore, the rate of interest should not be such that the borrower is never able to come out of the trap. And that trap is an extremely difficult situation. I think I'm sure everyone knows, but we have seen in the past people whose lives have been completely disrupted because once they get into a debt trap, they need to borrow to be able to pay the earlier one, and they borrow more and at a higher rate, and they constantly keep pushing themselves into the so-called debt trap. So rates of interest is understandably a concern, but I'm saying in the today's situation, if transparency and disclosure is there, so I think we are now back to the question: are lenders transparently disclosing the rates of interest? Now, if you're talking about this, previously people could hide the actual rate of interest, and the rate of interest could be different, and the processing cost or other charges could be different. Therefore, the APR disclosure wasn't required, or APR did not include absolute numbers. Now that definition of APR is very clear, it has to include all non-contingent charges, including all absolute numbers. Everyone translates all the numbers into an APR. The APR number is disclosed to the borrower. The borrower therefore makes an informed choice in a competitive market. Lesser of region for regulators to worry, but when it comes to bottom of pyramid borrowers, I'm sure they'll always keep on worrying. So that's the context, Anita, in which regulators' concern about excessive rates of interest comes. If you ask me question, what rate of interest is excessive, I wouldn't ever be able to give a number. If you ask me what interest spread is excessive, once again, I wouldn't be able to give a number. But question is, for every lender, it's very important to have a methodical approach to pricing. Having a vague, opaque statement in the interest policy that the company prices loans based on XYZ factors and therefore leave absolutely no guidance and allow the lender to use whatever opportunistic borrowing lending rate, that's not appropriate. Lenders have to be more transparent. The policies have to be more clear so as to provide a more unambiguous guidance to the pricing team as to how to price the loan. They wouldn't lending policy. I'm not expecting policies to start giving the rates itself, but at least the approach. For example, credit risk premium will be included, or the risk premium will include pricing for unexpected losses too. These points should be transparently coming clear so that it's a board driven pricing, not the loan officer driven pricing, because that leaves too much of a room for arbitrary action by the lenders. I think this is how vague I could make it. So I'm leaving it vague still, Anita.
Yeah, because you mentioned that exorbitant or excessive, there is no numerical parameter to it. Do you think that benchmarking your rates with the industry participants, having it matched with your peer NBFCs, will it be an adequate measure to ensure the compliance standards?
Uh,
Should you also
Actually,
add it as a part, because you mentioned the methodology to be a part of your policy. So should benchmarking also be a part of the policy then?
so let me put it this way. In theoretical parlance, when you talk about pricing, we talk about a pricing floor, we talk about a pricing ceiling, and I have to exist between the floor and the ceiling. The floor is given by the parameters. What are the parameters? Just mentioned: cost of capital, which includes cost of equity, acquisition cost, servicing cost, and the risk premium. This is the minimum that need to cover. Therefore, that becomes the pricing floor. The competition becomes the pricing ceiling, because no one will allow me to operate above the ceiling, because if there are others who are willing to lend at lower than my rate, I would probably lose my customers. I am once again assuming the borrower has a choice, and I think let everyone. I think you and other participants also would affirm me that today every borrower, no matter howsoever bad, has a choice. So the borrower has a choice, which is once again there are loan apps which allow to compare also. You can compare my rate with those offered by 3 other lenders. So in this situation where information is seamlessly available at the click of a button, the competitive rates, industry rates or peer rates become a sort of ceiling, whereas my own cost becomes a floor. So it's between the floor and ceiling though. Yes, to an extent, therefore, what you're saying is right, that the rates charged by other industry participants of my type of loans, my type of lenders for my type of lending and to my type of borrowers becomes a comparable, but that's at the most that's a ceiling, because the floor would still be. I mean, I should say that my pricing will be driven by the floor, keeping in mind the competitive rates as well.
Right. As you refer to pricing and as you're aware that most companies split the overall APR into a variety of charges, most of which are absolute numbers. Therefore, what do you think should be the consideration in pricing these add-on charges, which are non-contingent?
This is a very important point because uh, between the APR and the rate of interest, the gap could quite often be very significant. The APR might be like near to 30%. The ROI rate of interest might be something like, let's say, 24%, even lower. And therefore, there might be a huge gap between the APR and the rate of interest, which is accounted for by all kinds of charges. And people dwell upon breaking the charges into as many descriptions as possible. I'll probably have a loan processing cost, loan origination cost, documentation cost, widget cost, civil check cost, whatever. You would know better. We'll probably have a dozen of other costs. Now, we need to appreciate that for non-banking finance companies, these costs, I think for any lender who is in a particular business, the source of profit has to be from the primary activity. I'm in primary activity of lending. I'm not in the activity of selling insurance business. I'm not in the activity of selling documentation charges. I'm not in business of selling legal costs. So these costs can be largely compensatory in nature. They cannot be a source of profit. So if for example, documentation cost I'm charging 500 rupees, what's the actual cost I'm incurring on documentation? If these two are not anywhere proportional, then there is some degree of opacity in the pricing. Though I am required to disclose the APR, even while disclosing the APR, there has to be some rationale. So in what manner am I pricing the add-ons, the so-called processing charges, documentation charges? There has to be proportionality there as well. So I would always suggest that for these so-called add-ons as well, there has to be rationale. They can't be simply be left to arbitrary decision making. And in particular, these shouldn't be completely unrelated to the actual damage, actual cost, or actual compensatory element inherent for these respective items. Anita.
Hmm. So while lenders are disclosing the ROI and APR, and as you mentioned, the difference between both are these non-contingent charges. Uh, is the wider gap between both the LOI and the ROI and the APR, is it a matter of concern? And if so, why?
Well, of course, it's a
This-
matter of concern because larger the gap, more is the element going towards the so-called add-ons. And like I just mentioned, the add-ons cannot be a source of profit. In particular, okay, let's also understand that a lot of entities these days also have significant amount of income from third-party sources. For example, vendor subventions, discounts, etc., given by vendors. These may not be. Some people disclose. Some people don't even disclose these third-party payments as a part of APR because they say borrower's cost is not a part of borrower's cost. Borrower is not paying that. Borrower may not be paying, but when you talk about the aggregate cost of credit, the borrower would have been entitled to some vendor payment, which is now coming to me because I am involved in the process. If I'm saying I am getting something from the vendor, it's not unrelated to the loan because the loan resulted in the purchase and the purchase gives me a benefit. So that benefit is very clearly related to the loan. In any case, my pricing of the loan is based on the overall rate of return, and therefore I cannot be looking at these extras as unrelated to the loan. Therefore, even though I am not charging these to the borrower, but because these form part of my profit, we should still be disclosing that. Disclosure should therefore include the third party payments as well.
Understand. So
Uh-huh.
that is the reason because recently the changes in the APR, the KFS requirement and everything were introduced, wherein even third-party payments, if it is being passed, if it is being collected by the RE, that becomes a part of the APR.
So I think we're going a little beyond that. It's not a third party payment collected. It's not a payment at all. I didn't collect a payment from the borrower at all. But I've been paid by third party. For example, I've been paid by the vendor. If
Right.
that is part of my pricing of the entire transaction, it's not a cost to the borrower, but it's a return to me. So another way of looking at rate of return to the lender, even though it's not a cost to the borrower, should still form part of disclosure. You could probably disclose it separately that I'm getting so much discount in terms of percentage, it amounts to so much. Therefore, that's also part of my return. But in that it's connected to the loan, I would still strongly say it should be disclosed.
And moving to one more significant aspect, which is the insurance aspect, because most of the NBFCs we see bring insurance at the time of selling the loans. Insurance is a part, it is connected with the loan that is being extended. In this regard, insurance companies are also passing on a very not so insignificant number to the lenders in the form of commission, etc. What do you have to say about this?
So first thing is that though people didn't like it when the APR rules were amended to require insurance cost also to be part of APR. And there has been significant discussion. We ourselves have done substantial work on in what way will insurance cost form part of the APR. But insurance cost, even though paid to the insurance companies, still added to the APR. And you mentioned not so insignificant payment from not so insignificant. Therefore, you're saying significant payments come from the insurance companies. Insurance companies pay part of the payments as insurance commission, But given the fact that earlier there were limitations on how much commission the insurance company could pay, therefore a lot of it was coming in whatever different forms. Let's not get into that because that's a different domain altogether. But yes, insurance companies are paying a significant amount of money, and most of the lenders, in some way or the other, require, I wouldn't use the word force, but require the borrower to take insurance policies, and that insurance policy becomes a source of profit. So these profits coming by way of cross sell of services, which are though not payments to me, but the payments going to the insurance company, but there is, I have an interest in that. So in some form, disclosure of these cross sell services which flow back to me in some form, I would very strongly say regulators should actually ask for these disclosures as well, because otherwise cost of the credit to the borrower includes the cost of getting an insurance as well. While larger part of that goes to the insurance company, but part of it flows back. So if I have an interest in what I'm selling as a part of the loan sale, I have an interest in that. It's not as if I have no interest at all. I have an interest in that as well. So that interest should be a disclosure, in my opinion. This is not something regulators are currently asking for, but I think it's high time that we should think of requiring this disclosure as well, even if it's not regulatorily required. Lenders who are transparent in their disclosure should think of disclosing that. That would set a very important whatever leadership disclosure when it comes to borrower-centric disclosures. Anita.
Okay, coming from the disclosure requirement, one very critical issue, this is the issue of evergreening that has been highlighted by the RBI. Now, while evergreening leads to underreporting of the NPA, there are other concerns as well that are associated with it. As lenders, what are the safeguards that needs to be built to ensure that loan renewals or restructurings that are being undertaken by lenders, they don't eventually lead to evergreening?
So mostly if the intent is to support the borrower's ability to repay my own loan, I have a loan going with the borrower. I'm giving in some form, I'm giving another credit facility so that the borrower's ability to pay my existing loan is supported. Every lender would know that that's what I'm doing. Now they might use sophistry to argue that this is actually not support to the borrower, but they know fully well that I am extending the second facility to assist the first one. Merchant of Venice, I think, has an example of that. That when I would lose one arrow in a particular direction, I would dart another one in the same direction, hoping that this time I'll find both. The lender gives one loan which becomes sticky, then he gives another loan hoping that both will come back, and then he gives a third loan to be able to or hoping to be able to recover both, and that's how the arrows keep on being shot in the direction which we are unable to find the arrows back. So this is something that lenders would be aware of, and bankers were doing it for years. Bankers have been doing it for, I think none of the banks in the country is away from this practice. When it comes to NBFCs, when you give a top-up loan or you give a personal loan to a borrower who has a running loan with you, it's very important to ensure that there are preconditions for grant of the second loan. That on the existing loan there is, as of now, there is no default or whatever X limited number of default. In the past, there wasn't a default. If there was a default, the date of rectification of that default and the date of giving of the new loan has a significant gap. For example, it's not that I gave a new loan today. 5 days back, the borrower cleared his existing default. Because that is also once again indicating that the intent of second loan was to make good the default. So if proper safeguards are taken, I think the real I would say the cause of suspicion in that the subject matter of suspicion in the entire so-called restructuring question would be the top-up lending. Top-up lending or a personal second loan to the same borrower, call it by whatever name, call it personal loan, call it second loan, call it whatever loan to an existing borrower, that always comes under the regulatory cloud as to is it basically for supporting the borrower's ability to pay. So have a very rigorous credit check for the second loan, list of conditions to ensure that the second loan is not being used for supporting the first one. Anita.
I think this is an important issue. And next, I would like to maybe because there were two MFIs also who were recently brought under the scanner of the regulatory action. Specifically coming to MFI loans, microfinance loans, it can be NBFC MFIs who are extending these loans, or it could be normal NBFCs also up to 25% that they are extending these loans. These loans are unsecured and extended to families that have an annual income of less than 3 lakhs. Now, the assessment of this annual household income and the computation of the FOIR, which is the fixed obligation of repayment, this has been stated that it is in contravention to the regulatory requirements. What could be the factors to be taken care of by lenders who are extending these kind of MFI loans?
It's a very serious point, and well, it's money. I would say academically we have been commenting for years now. I think long time, it's almost 15, 20 years now that the fixed obligation to income ratio, which is currently set at 50%, should actually not be more than 35%. But well, microfinance would probably, most of the microfinance business would probably cease to exist if we were set that kind of aggressive fixed obligation to income ratio. But what we have demonstrated is that at lower income levels, we're talking about a borrower with household income of 25,000. Sustenance expense for every family is still a bare minimum. But somebody who's earning 25,000 cannot be eating lesser food and spending lesser on medicine, bare basic medicine, than any other person. You'll still need 3 rotis and you'll probably need chawal dal, and therefore there'll be a chawal dal expense which itself will add up to 5,000-6,000 rupees a month. You'll probably be spending another 500 rupees for electricity. You'll probably be spending another 500 for child's education. You'll probably need a cell phone, which will take cost. So all in all, sustenance cost itself will take about 40% of the income of the family which is earning 25,000. If the EMI is from the loan take 50% of that income, I'm left with nothing to survive. I'm left with nothing to save for emergencies. If the family has, for example, a little medical issue, what do I have to help me in that emergency, right? So FOIR is a very, very critical number. It's not a regulatory ratio. I wouldn't view it as a regulatory ratio. This is a very basic part of what is called responsible lending. As a lender, I have to be responsible that I'm not pushing my borrowers into a necessary situation of default. Because if I'm lending at a with a loan size where the fixed obligation to pay me, let alone other fixed obligation, itself is half of his income, and the income is how much? 25,000. If 50% was the fixed obligation at an income level of 1 lakh a month, I would have still understood, because I still have sorry, sufficient amount of cushion there because my income level itself is high. But at 25,000, how much do I have to take care of my emergencies and my, urgencies? That's a huge question. Therefore, FOIR is a very, very important number. As far as assessing the household income is concerned, I think there are people mostly rely on what you call occupational studies. If husband and wife are both are working, you'll probably say, okay, husband must be at least earning 15,000, wife must be at least earning 12,000. So that's how they compute household income. One of them is working, probably the assessment is done based on what occupation. Is a carpenter? Well, he'll probably be making 20,000 at least. So driver probably will make 18,000. So occupational studies depending on the occupation. That's the way to assess the household income. But I would be very, very particular about the fixed obligation to income ratio. And I would argue that appropriately, when I say 35%, where do I get the number from? Even the World Bank studies and global responsible lending standards at lower income level talk about 35%. I think a long time back, I'd actually done numerical work also to show that if we are living FOIR of 50%, we are actually having a probability of default which is as high as 60%, 50-60% probability of default. Because any fluctuation in income, we talk about a daily worker, think of a carpenter. 10 days is out of work because of, let's say, some sickness, he wouldn't be able to pay. 1 month is not able to pay last month's EMI due, plus the interest on that, he would probably have a running in problem. The deficit always increases. He would never be able to clear the loan. So the only option, he has to take another loan to pay the earlier one. Anita.
It becomes important that we are not just considering this particular microfinance loan, the repayment obligations coming from the microfinance loan, but the borrower may have other loan that it might have taken from other financiers. It could be the house loan, home loan, or gold loan. These should also be considered while we are
Without
computing
doubt.
overall
If there is an
obligation.
obligation to service, without doubt, yes, I don't even have a slightest doubt.
Right.
Anita.
Next, I would come to outsourcing of financial services. Now, this has always been a matter of discussion, starting from what can be outsourced, what should be considered as outsourcing, evaluation of the service provider to whom the activity is being outsourced, monitoring the actions of the service provider, and so on. What remains important is the reliance of on such outsourced activity and ensuring that the core functions remain with the lender. What are your views on managing the outsourced activities?
Anita, outsourcing is very fairly your domain rather than mine. Therefore, I would ask you to give further comments on that. But the little that I know, I would just say two things. A, core functions anyway cannot be outsourced. That's something which is beyond outsourcing. But people do outsource whole lot of operations, particularly technology. People do outsource. People do outsource quite often manpower. Manpower is sitting in another company. My company is simply availing services. This has become the business model for a lot of entities, quite often even banks also. In my view, this is a cause for operational dependence. And I'm not sure what are the rules of economics when people think of hiving off activities into different companies. Probably they're trying to ring fence. But operational dependence is a source of operational risk. And the more you depend on others may be your group companies itself. But after all, it's talking about a corporate entity. We're talking about the corporate entity itself. So the more you depend on others for these activities, which are crucial to, they may not be core functions, but they're still crucial to our operations, we are creating an operational risk. But Anita, you would know better, so you why don't you give your views?
No, I think I would completely agree. And in today's time, I think it is important to consider not just the outsourcing of financial services, but IT outsourcing is also an area of focus that RBI has been focusing on. And there are concerns because what kind of outsourcing is being done, what is considered as material, because if the entire lending operations are digitized and I'm having reliance on technology and software, and that is the kind of support that I'm relying on a service provider, then the activity that is being relied on is an essential activity and it becomes a material outsourcing activity. So this again becomes important for us to ensure that whatever are the requirements under the outsourcing regulations, both for financial services as well as IT outsourcing, that needs to be taken care of. Evaluating, conducting a DD of the service provider. Now the DD will not only take into consideration the financials and the equity and the financial standing of the service provider, but also with respect to the facilities that it is providing, the business continuity of the service provider. All these have to be ensured. Proper DD must be conducted of the service provider before I'm entering into an arrangement with the service provider.
Anita, I just
And
have to add that when it comes to outsourcing, are we simply talking about complying with the outsourcing requirements? Or
no,
are we talking about first a very fundamental basic question, should I be doing it myself instead of depending on others? Is this something which I should better do myself than relying on others? For example, let's say loan, there are activities which are better done by others. For example, IT. Now, I'm not an IT entity, so instead of me investing in IT myself, I'll probably in-source it from somebody who's specializing on IT. But if it comes to loan processing, for example, as an entity, once again, one will probably say, well, I'm into digital lending and therefore let the lending app do it. So the basic question is your type of lending, the activity for which you're depending on others. Should you organizationally have your own in-house capabilities or should you depend on others? I think more fundamental question for outsourcing is why outsourcing? There should be an economic answer first before a regulatory answer. People search for tick box approach. Am I complying? Do I have an outsourcing policy? Well, everyone has an outsourcing policy, but the outsourcing policy for everyone exactly says the same thing. Question is not outsourcing policy. Question is, have you done an evaluation? Can you justify for cost or operational efficiency? Should you be outsourcing? That's the question.
Right? The dependency and ensuring that it is not a core function that you are actually
Economic
outsourcing.
efficiency itself, economically, operationally, is it efficient to outsource than to do it in-house?
Right. I think moving ahead, in addition to the press release, recently we have seen that there are supervisory concerns that the regulator has been raising, revolving line of credit. And we have news that some NBFCs have even been asked to withdraw their supply chain financing business. So over here, I will have two questions for you. First, what is the issue with revolving line of credit and why is it a concern area for RBI, specifically if the revolving line of credit is being extended by an NBFC? And secondly, what is the issue with supply chain finance? Why is there a scanner put by the RBI on that kind of a funding?
So maybe I take the first question first before we come to the second. What's the issue with revolving line of credit? This question has been bothering, and Anita, you would affirm that this question has been bothering us for years. We have never said that NBFCs are permitted to offer revolving lines of credit. We said lots of NBFCs are doing it. We are not sure whether NBFCs actually can do, because we are not able to find a very clear answer from any regulation saying that NBFCs cannot offer revolving line of credit. I think the easiest example will be working capital credit. Working capital, not a working capital loan, working capital credit, a kind of an overdraft where the bank gives an overdraft, you draw money, use the money for whatever purpose. When you don't need the money paid back, then you draw it again. So so-called typical overdraft facility, banks provide it. Can NBFCs provide it? We always said, well, we are not sure. Quite often regulations also talk about a loan or an overdraft provided by a bank and a loan provided by an NBFC. RBI has never been saying loan or overdraft by an NBFC. So when it comes to revolving facilities, revolving credit facilities, there's always been a shade of gray. If we talk about a revolving credit, which is backed by an instrument, for example, a credit card, or let's say an app. A credit card is also an example of a revolving line of credit. I have a card in my pocket, so if I don't have money, I have the card. I have 10,000 rupees in my pocket and I have a card which gives me a facility of 1 lakh. How much money do I have in my pocket? 1 lakh 10,000. The card becomes an equivalent of money. So what's the importance of revolving line of credit? It becomes as good as money in my pocket, which is actually called credit creation function. Credit creation. I have 10,000, but now the money in my pocket is 1 lakh 10,000. We have an additional instrument which allows me to dip another 1 lakh. Therefore, in a sense, the issuer of the credit card has created credit. As you understand, banks are into credit creation business. One of the traditional functions of banks is credit creation, because they create credit, the overall money in the system. If the money in the system is 1 crore, for instance, and banks have enabled another 2 crores worth of working capital credit, the money in the system becomes 3 crores because I can spend up to 3 crores without bothering. Right? So working capital essentially enhances the ability of of the beneficiary to go beyond his actual means. My actual means is only 10,000 in my pocket, but I can spend up to 1 lakh 10,000 because I've got the card. So sure enough, when it comes to an instrument or an app by which revolving line of credit can be used, it becomes equivalent of a credit card. And for credit cards, there are definitive regulations. When it comes to non-instrumental revolving lines of credit, let's say an overdraft facility, while there's no regulation, but the reason for the regulator to come and say that this is something which is permitted for banks, not for non-banking finance companies, is that non-banking finance companies are not in business of credit creation. They can be in business of lending. I can give a loan of 1 lakh. That's okay. Once I use the loan of 1 lakh, I've used the loan of 1 lakh. 1 lakh rupee loan has been lent. It comes into my bank account. It becomes money actually. It's not a right to draw money. Whereas a revolving line of credit becomes a right to draw money, a right to draw money anytime, right to draw money anytime, and the right to draw it for any purpose. Working capital, well, working capital is working capital. I can use it for my work. It's a capital that I can draw for my regular uses. So neither is the end use control, nor is the timing of use control, nor is the ability to repay ever control, because I can pay it any back, pay it back anytime. So the facility where I can use money anytime up to a limit, use it for whatever purpose, use it whenever I like, return it whenever I like, and then it replenishes the moment I return. That's what I would call a revolving line of credit. And if the regulator's understanding is this is something which is permitted for banks, I wouldn't say the regulator is grossly mistaken, because this is actually, yes, that's what is credit creation function. Non-banking finance companies start credit creation, then the very macro control of the RBI on money in the system, the so-called M3 that regulators quite often, I mean, the central bankers quite often talk about. Non-banking finance company is not a part of credit creation function. Banks are. Banks are under control. Therefore, whether sorry about that. Whenever the RBI wants to curb the availability of money in the system, they'll impose controls on banks. They don't do it for non-banking finance companies. So the very credit control of the central banker on the banking system will get weakened if NBFC started giving revolving line of credit. So the first thing that we need to understand is the nature of revolving line of credit. I said several features: ability to draw at any point of time up to a limit, ability to return. Once I return, it replenishes, and I can use it for spending in general, for anything. There's no, I mean, if it's to be used only for a particular payment, it's a line of credit, but I wouldn't call it. First of all, it's a question whether it's actually a line of credit or simply a loan facility. We can use it only for a particular purpose. So it's a facility, but not a line of credit. Number one, it has to be line of credit, which means I'm LOC, line of credit. I'm allowed credit up to a particular limit, and I can use it for whatever purpose. And that line of credit becomes revolving, which means it auto replenishes. That's what is feature of revolving line of credit. That's the first question. And like I mentioned, if the regulator says that non-banking finance companies cannot offer revolving lines of credit, while it's not coming from any specific regulation, but the underlying philosophy is still, to my mind, clear. Part two, supply chain funding, is that a revolving line of credit? I would mostly say no. Because supply chain funding, first of all, what's supply chain funding? For any large entity today, enabling the supply chain, enabling my vendors and enabling my customers, my vendors to grant credit, right? And my customers to avail credit. I hope you're getting. For my vendors, what is needed is, are they able to offer me credit? And for my customers, the key question is, are they able to buy on credit? Right? Both of these are critical for me to manage my working capital. And largely, if you understand, what does an entity need working capital for? I need working capital for managing accounts receivables. If I'm able to sell on credit to my customers, and the customers through the supply chain funding are able to pay me instantly, I wouldn't have receivables. If I don't have receivables, that would mean I don't need anything to fund receivables. I would still be needing money for inventory, however, but the inventory is bought on credit. So I buy on credit, fund my inventory, sell on credit, but I get paid in cash. Therefore, both sides, I am able to get funding for inventory as also for receivables. That is what is called alternative way of managing working capital. I'm able to avoid substantial blocking of money in working capital, because both the ends of supply chain, the upstream end and the downstream end, both are enabled by me, but they're funded by somebody else. So supply chain funding is just the way to manage working capital. There's absolutely, there can never be anything wrong. In fact, that's the globally accepted best way for people to manage working capital. And I hope it's not difficult to understand that if the anchor is strong, the entity in between is strong, I am far greater in a position to enable funding by my vendors and to my customers than the customer or the vendor himself. Their creditability is not that strong, but I become the anchor. I support the credit. So that is the best way to manage working capital. There's nothing wrong in that. Is supply chain funding revolving line of credit? If you structure it properly, to my mind, no. Why not? Very simple. If I am selling goods on credit and my customer has a supply chain funding with a lender, the supply chain funding is for what? Is it for spending money anywhere? No, it's only for buying goods from me. I make a sale. On the sale itself, the customer is able to pay. So he gets a funding for paying me. Likewise, if my vendor supplies me goods, he gets funding for the invoice that is raised on me. So in both the cases, the usage is completely linked with a purchase or a sale. It's not money which is available for withdrawing. So the credit creation function with which I started saying, is it like money in my pocket? Surely not. It's like getting funding for a specific purchase, a specific sale. Hence, no question of this being viewed as a revolving credit facility. It's like any other funding. Every funding has to be for some end use. In this case, the end use is very clear, to make purchases or to make sales to a particular entity. And for a specific invoice only. It's not money which can be tapped for just about anything. Therefore, this can never be viewed as a revolving. I think it's because people have been using this kind of terminology, that therefore probably the supervisors are quite often impressed by use of terminology. But you explain it or structure it properly.
Structuring is not just about the use of terminology only, but also the terms of this kind of a vendor
That should,
finance or a
yes,
purchase finance. These
which
should
is,
be structured properly.
and it should be linked with a specific invoice. So I'm not allowing you to use my 1 crore for
Any
just doing
purpose.
whatever. You
Right.
buy from a particular vendor, you buy particular goods. Typically, I would probably say also goods which are approved, the invoice is approved by me. So
Right.
if I'm granting against a specific, and then most importantly also, that the term of repayment is therefore linked with the withdrawal. If you use my funding for buying under the particular invoice, that invoice has a usance. It's not a like revolving line of credit. I don't need to pay. There's no fixed time for repayment. Here, this is, I have a 30 days or 60 days or 90 days credit period within which I need to pay the invoice. If I don't, then I'm in default. So this is very, very different from a revolving line of credit, or similar to it's very different from an overdraft. And therefore, I don't see any regulatory concerns here.
I'm sure we are short of time, but just one more question which we have from one of the participants. Specifically in case of co-lending scenario, there may be a 6 to 10% interest rate differential between the bank ROI and the NBFC ROI. However, blended ROI to borrower would be decent due to the power pricing by banks mainly. Can this be an issue with the RBI as they have permitted co-lending and did not mention any pricing regulations?
Uh, so I think once again, the issue, at least from fair lending perspective, the issue is your pricing of loans okay? If there's a 6% differential, question is on what proportion of your contribution. 6% differential on a 20/80 partnership, how much does it become? For example, if I'm lending at 18% and the co-lender's expectation is 12, I'm getting a 6% differential. On my 20%, it becomes 24 plus it becomes almost like 42%, 44%. So on my funding involvement, the rate of interest is 44. So if there is a question on, is the rate of return excessive? If I have a prefixed co-lending arrangement and I'm getting 44% on my 20%, I think the question is still the same. Am I pricing the loan right? Because there was given the fact that I have a co-lender who is promising money at 12, the cost of funding is much lesser. And like I mentioned, the approach to pricing of a loan is a function of cost of money. In a co-lending scenario, the money is not coming entirely from my balance sheet. The money is coming, 80% of the money is coming from a co-lender. So cost of lending itself drops down, drops down. The cost of lending drops down. Then the floor rate also has to drop down. That's the way I would see it, Anita.
In co-lending, it gives us an advantage as well because the bank may be having a lower rate of interest for the 80% share, and I might have a higher rate of interest for only the 20% share. To the borrower, the cost may be averaged out, and that may not be a very significant amount. So I think that
Hmm.
gives a
Well,
fair picture to the borrower as
yeah,
well.
man, I would just reiterate to say that when I'm lending myself and I have a leverage on my balance sheet, the loan comes from my own balance sheet. And therefore, what matters is what is my cost of capital.
No, exactly.
But in a co-lending scenario, I'm putting 20. The 80 is coming from somebody else. So cost of capital for me is only for the 20%. The cost of capital for the 80 is the threshold rate given by the co-lender. Therefore, the cost of capital itself drops down. If the cost of capital drops down, expectation would be that the cost of lending should. I mean, the whole purpose of permitting co-lending was to pass on the benefit of cheaper borrowing rate to the borrower. Therefore, to say that my rate would remain the same even when I'm a co-lending arrangement, to my mind, I think we are probably missing on the very purpose of co-lending.
Right. I think, and as a part of our pricing policy, also the approach should be to contain the risk rather than just transmitting the cost to the customers. I think with that, we will come to an end to this
Or do you want
Shastra.
to entertain any questions from the audience as well? Or
I don't see any questions on the
okay,
chat
okay,
box.
perfect. I think
In
everyone is
case,
so very happy.
yeah,
Okay. Thanks everyone. And thank you, Anita. It was wonderful having this. I think it's very timely. It's very pertinent. And of course, these questions can never have ready answers, but it's very, very important to flag the question, discuss on those. Thanks. Thanks, everyone.
thank you, everyone. Thank you.